Hello, this is Quayne. I'm the Premium Finance Broker of CWF Group. I'm also the director and also author of Keep Calm and Mortgage On. If you haven't got it on Amazon.com, please check it out. So I'm releasing a few series of video blogs to talk about the things that are concerning my clients. They ask me every day and I thought I'll just record it, share it out there. You know, knowledge is power. So sharing is also caring. So in terms of this week's or this month's video series that I'm releasing, it's all concerning one key factor that's affecting most of my clients, and it basically starts with S. It's servicing. So banks have tightened up on lending like crazy. Tighten up. You'll see that the fact that investor rates are going up, interest earnings are skyrocketing. There's a more favorism towards owner-occupiers. So, there's a lot of, campaigns against investors. I guess it's working now. Owner-occupiers are getting, first stamp duty exemption on second established homes. They're getting more grants, and they can access to super to buy their first home as a form of deposit. So, this video, we're going to talk about servicing. And the key thing to servicing before you walk into a branch or see another broker is the thing that you should know. It's called loan to value ratio. So loan to income ratio. L2I. Alright, so what is loan to income ratio? This is a new benchmark introduced by a lot of banks. That's, for example, St. George, Westpac, and National Australia Bank. They're introducing this. Loan to income ratio is basically a test where they get the loan divided by your income, and if that is more than 8, then your loan gets automatically declined and goes into further assessment. So what do I mean by that? Okay, so if, for example, you have a loan that is, say, $600,000, right? Okay, this is the loan. If your income is $100,000, okay, that divided by that equals, what does it equal? 6. 6 is less than their loan to income ratio test factor rate, 8. So 6 is less than 8. What does that mean? It means you pass. Okay. What happens if your income is lower than that? Say, for example, your income is, say, let's say average of, say 70. Okay, $600,000. Okay, let's do the math together. I already have the answer in my head, but I just want to do it with you. Well, if you're watching this, 600,000 divided by 70. That's 8.5. 8.5. So what does that mean? If the answer is 8.5, okay, you fail servicing. So what does that mean? That means you automatically get pushed on to a team that will further harshly assess your application to see why you should get this loan. But this is only in place for interest-only loans, okay? Interest-only loans. So the next thing you do when you go into a branch or see another broker or whatever you do in terms of getting lending, ask them, does this bank that is credit scoring or assessing application, do they have a loan to value ratio? What is it? Is it 8? Is it 7? Is it 9? Ask them before you submit an application. And also another tip is, before you go to any bank, always ask them, what is your assessment rate? Assessment rate. What is an assessment rate? Assessment rate is when your application goes into the bank system. What is the rate they're using? So they're not using. Don't be naive. They're not using your your 3.8 own occupier rate or your 4.5 investor rate. They're not using that. They are using, for average, some of the banks, 7.25%. Okay? Particularly some banks are using 8% at the moment. For example, ING. So if your servicing is tight, remember, don't go to a bank and submit your application with a really high assessment because you're going to get declined. Now, as a tip, when you go to a bank, always ask, what is the assessment rate? And most often, the bank teller doesn't know. And be very careful. I have a lot of clients who experience this before they come to me. They go to a bank teller. The bank teller goes, oh, you got to speak to my lender, and they schedule an appointment. And then the bank teller is just there to sell you the application. Whether it gets declined or approved, it doesn't matter. That's part of their KPI. So they don't go to you and go, hey, this is our assessment rate. You might have a risk of getting declined. Maybe I should do more research for you. No, they'll go, look, awesome. We've got an awesome product. We've got an awesome rate. Let's submit an application. But essentially what that really means is let's submit an application and hope to God that it gets approved. And you don't want to do that because there's a thing called credit scoring or credit rating. So credit rating, everybody, since they were born, they have a credit rating. Starts with 1,200 points. Okay? I've got a really pretty good credit rating. I've got about 980 points. Okay? I'm not scared to tell people. But what happens is, the reason I have a high credit score is because I'm really vigilant of where I put my applications. And usually for our clients, we're very vigilant in that. That's why we have access to Equifax, which is a paid membership to see the credit scores of our clients, which we pay for our valued clients and is anonymous. Now Equifax, you're like, what the hell is Equifax? Equifax was usually known as VEDA. Do a VEDA check. Now it's called Equifax check. So what happens is every time you get declined, you lose points depending on how big the application is. So imagine, on average, when I see my clients, I always see points around 411 to 511. And that might be your score as well. Because if you're guilty of this, balance transfers from credit cards to credit cards, even though you don't incur any debt, you're losing points. And every time you walk to Woolies and they go, hey, I'll give you $50 to sign an application for a credit card, and you sign up, even though you don't know whether they're going to submit the application, they are actually submitted the application on the spot, and you're losing points. So be careful in terms of servicing. Really guard your credit rating. And always make sure you know what is the assessment rate, what is the loan to income ratio, and always be vigilant who you use. Now obviously I'm not going to plug my services and say, hey, come use me, but the advantage of using a broker versus a bank, we have a raise of lenders from 40 lenders. I've been in the industry for 8 to 10 years. You got to see how much experience that the broker has. So sometimes it's not more than the relationship. It may be an uncle, maybe an auntie that was driving a taxi or was a gym instructor and then suddenly became a broker. Seriously, I have done. I've been an assessor at a bank. I've worked with the top brokers in the country before starting my own firm. I've been in the industry for a long time, and I'm also MPA top 30 young gun broker. Now, not to just basically harp on of my credentials, but the third thing that you should know is basically, do you have an experienced broker working with you? And not just to buy that first property, but how do you accumulate the first, second, third, and fourth property? So always have a good team behind you, and then make sure that broker works with a really good accountant and a financial planner. So 3 things to take away today, okay? Always ask the bank or the person you're seeing, what is the bank's assessment rate? Number 2, what is the loan to income ratio that lender is using? And number 3 is, am I using a credible, experienced broker that has testimonials to support what he's done for other clients? Until next time, keep calm and mortgage on.